will join us now. Herald Van Der Linde, Head of Equity Strategy Asia Pacific at HSBC, and Viktor Shvets of Macquarie Securities, both joining us on the phone line from Hong Kong. Gentlemen, good morning and welcome to both of you. Herald, that's the first question to you. Up until for the past 12 weeks or so, the Chinese fall was only that, a domestic fall did become a contagion. But yesterday we saw this contagion spreading to commodities. Now does it get worse for all risk assets all over the world?
Yeah, indeed. One particular issue that seems to be at play is that it is, for certain players, quite difficult now to liquidate certain trades in China, given that a lot of shares are being suspended. So we see this now being spilled over into some of the into the Asian markets as well. And as you look at the screens today, it is quite a difficult day for markets. So that could be one of the issues being at play here.
Similar question to you, Viktor. Do you think now the contagion spreads?
Yes, I think that's a very fair summation. And it's not just China. Of course, it's Greece, it's Puerto Rico, it's many other things happening at the same time. The lesson that one really should draw from what's happening is that you should never, ever try to pop a bubble. The world is so highly leveraged that bubbles popping anywhere on a screen or any country attempting deleveraging can easily create an infection all around the world.
Okay. Well, just to extend that point further, Viktor, I was going through your note where you say that you don't believe that the Chinese government or the Chinese regulators have done enough to support the equity markets. What more do you think China should do to sort of stem the sell-off?
Well, it's not so much support equity market as essentially convince people that Chinese government will not tolerate high degree of volatility. Remember, BOJ today basically buys equities. It buys bonds. ECB is buying corporate bonds as well as treasuries. Remember, Federal Reserve was buying every conceivable security 3-4 years ago. So the key question is not so much correction in the market. I think Chinese leadership don't mind that the market's somewhat correct. The key question is the depths, the ferocity of it, and substantial increase in crystallized volatilities that you have. So that's the issue. So the question is, have they done enough to slow down the volatility or to remove some of the volatility? The answer is no. At this stage, it's very tentative, very small steps. It's nothing like a bazooka. It reminds me a lot of what ECB used to do between 2009 and 2011. And that's precisely why ECB was unsuccessful in those first 3 or 4 years.
So what do you think the Chinese government should do to stimulate not just the markets but the economy as a whole?
Yeah, or the whole range of things. If you look at China, it's the only out of the top 6 economies to be operating in a very steeply positive real interest rates. Particularly if you use PPI as your deflator, which is much broader than just CPI. So can they cut rates? Absolutely. Number 2, reserve requirements is an obsolete tool. It was very useful when there was a flood of money coming in, but now about $400 billion in the last 4 quarters alone left country. So you still get FDIs, but a lot of money is leaving. So do you need to operate at 16 to 18% reserve requirement ratios? Once again, if you look at the U.S., it's 1%, to give you perspective. The third area is pure QE. Nobody can deleverage. Nobody should even try to deleverage. It's too risky. I think IMF was absolutely right to say we've got to get used to living with leverage rather than trying to deleverage. So QE policy, very aggressive QE policy. Now, the People's Bank of China is doing various things which normally would classify as a QE, but it's haphazard, it's all over the place. So once again, a more powerful QE policy, and finally, fiscal spending. Now, I'm not suggesting for a second that that actually will create long-term sustainable position. That's not the case, and that's not the objective, either for China or Japan or Eurozone or US or Korea or pretty much any other country. It's just a question of managing your debt burden.
Okay. Herald, more importantly than what China should do is what investors should do. What are you doing? Are you legging it out, getting into cash? Cash in which currency?
At the moment, I think from an Asian equity point of view, that would not necessarily be the road I would go for. We see a tremendous amount of volatility in markets, of course, but I think this actually throws up some interesting opportunities in markets as well. Chinese equities, of course, have reacted quite sharply, but here and there we see that very good value starts to emerge. Companies which are trading at PE multiples that haven't been trading on for the last 12 to 18 months or so. So selling now and going into cash and hide is not necessarily a strategy I would advocate. Does it mean that the market will bottom from here on? I honestly don't know. There's an enormous amount of deleveraging taking place in that Chinese market that might take some time to do, but starting to nibble at these markets and building some positions in equities is probably a better thing to do at this particular point in time.
So what are your favorite equity markets in Asia now?
At the moment, the markets I'm looking at, I mean, they're moving quite considerably. But actually, I would take a serious look at the Chinese market. Say the H-share listed stocks here in Hong Kong. We see quite a amount of volatility in that, but we actually this morning upgraded H shares from on the way to neutral. We think this is a time to start to get back into some of these names.
Okay, that's interesting. When it comes to India, particularly, Herald, you did see the writing on the wall pretty early. You have cut your weightage on India from overweight to underweight. Do you expect to see more adjustment of valuations downwards and perhaps more downside in the Indian markets in the near term?
Yeah, I think there's still a little bit of risk. You're right. So we've been underweight for a couple of months now, and the story was really that there would be disappointment on the interest rate front and potential slowdown in growth as well. And what we've seen is that some of that is now playing out. Earnings growth is being revised downwards in India by about, say, 10% over the last 2 months or so. So that's taking place now. Valuations have, of course, come off a little bit as well. So on the margin, that's still the case. But I think there's still risk that maybe interest rates won't go down in India. We'll only get a clearer picture of that in August. But the 2 or 3 boxes which we ticked and said, okay, you're going to be cautious on India, what was it, 2 or 3 months ago, I think 1 or 2 of those boxes we can clearly tick now. So the conviction level on that is falling to a certain extent. But for the moment, we remain underweight on India.
Okay. Same question to you, Victor. At the moment, what would be your hierarchy of markets in terms of preferences?
We tend to separate macro call from a stock picking call.
Sure.
And the reason for that is very simple. That stock picking is no longer possible in a sense of unless you restore your business cycle and the capital market cycle to normality, which probably will take more than a decade to complete, there is no way of doing sector rotation. There is no way of doing proper stock rotation. So when we look at the stocks, we continue to emphasize deflation, stagflation, and thematics, because we think over the next 1, 2, 3, 5 years, either deflation, stagflation, and or thematics will become far more important. So we're on 3 portfolios which basically emphasize higher ROEs, high margins, brand name recognitions, free cash flow, and largely ignore valuations, or we look at thematics. And we haven't really changed that positioning. Those portfolios seem to be doing quite well even today in the volatility. For short-term macro calls, because if you're only looking 3-4 months, there is no point of trying to pick stocks. You really need to look at macro. We downgraded India from a significant overweight to a slight overweight. I actually will tend to agree that I think India getting to the stage that one can actually put more money into India rather than less. I still think earnings per share estimates are too high. I still think multiples are too high. And if deflation requirement gets stronger and the capital flows get tighter, I think India will have a problem, but maybe we're approaching the time when we can put more money into India. We traditionally were underweight most of the ASEAN. That includes Indonesia, Malaysia, and Thailand. We still don't like those areas, but I think on the margin we feel a little bit more positive, particularly regarding Thailand and to a lesser extent Singapore, Malaysia. China, we have been overweight. We have been overweight for probably 2 years. I still don't think, and when I talk overweight, I don't mean A shares, it's MSCI China that we're discussing. I still think that China is at the beginning of very earliest stimulatory and liquefaction cycle, very early. So if you take a few, 3-6 months out, I still feel okay with China. And finally, we traditionally have been overweight Philippines and Taiwan. We're still there, and somewhat underweight Korea, and I still don't see a reason to go deep into Korea.
Okay. Herald, what is the feedback that you get from the foreign investors that you interact with? Have investors started taking money off the table from the Indian market, or is India still a very overcrowded trade?
If we look at the data, we do quite substantial work on fund positioning every month. And if we look at the data, we actually see that people are still overweight. They're not as overweight anymore as they say were at the beginning of this year, but they're well into overweight territory. So I would say that, at least from what we can see and what we can measure, that's to a large extent the mutual funds industry, they are quite overweight. When I was on the road in the US and Europe a couple of weeks ago, I did have the impression that maybe the conviction levels on India were falling, and pretty much actually what Viktor just said as well. I think a lot of people were overweight and have cut that to a certain extent. But that's most are still, I believe, in that overweight territory. Typically on the weight on ASEAN, and prefer either North Asia, China, and then Korea, Taiwan in addition to that.
Okay, Viktor, what about commodities? Crude as well as metals, though crude more importantly, much more falls to come?
Once again, the way I look at commodities, they're no longer about demand and supply. That was a story 10, 15 years ago. Commodities are basically financial instruments, just like everything else, because quite often there is 5 or 10 times more financial instruments outstanding against commodities than the demand for underlying commodities. And the way financial instruments react is primarily to liquidity and primarily to pricing of other financial assets rather than demand supply as such. So the key question for us is that whether I think the supply of the US dollar will remain very low, other forms of global liquidity might contract, and if that were to happen, do I think at the end of the year or early next year, commodities might take another step down? To me, that's a realistic probability. So I think for the time being, I actually felt that commodities should be relatively neutral. But then there should be a pretty strong possibility towards the end of the year or sometime early next year for US dollar to be substantially higher than where it is now, and commodity complex, not just oil, making another step down. Now for India, that's a plus and a minus, because India really needs a Goldilocks. India cannot tolerate very low commodity prices simply because that implies very low global cyclicality and a very restricted capital flow. On the other hand, India cannot tolerate high commodity prices because the country becomes stagflationary incredibly fast. So India needs a Goldilocks. Right now that Goldilocks actually is still there. But the interesting question is what's going to happen towards the end of the year or early next year if, in fact, normal business cycle does not return, and at the same time neither ECB, DOJ are loosen up more than what they've done already, and if Federal Reserve does not do a QE4.
Okay. Well, we have to end this conversation anyway, but the phone lines are protesting. Herald, Viktor, thank you very much for joining us with your thoughts today.
Thank you. Have a good day.
Those were contrary views, but still not giving too negative a view of India.
And amidst all that caution, the market has actually staged a bit of a recovery. Okay. So the Sensex was down.